I'm Nicholas Bornaldis, president of Capital Inc., and I would like to welcome you to our ETF industry roundtable. I would like to, we have a great group of panelists, and I would like to thank the New York Stock Exchange and Douglas Yones, with the head of ETF at the New York Stock Exchange, for not only supporting the forum year after year, but also for putting together this tremendous panel. So Douglas, thank you, and thank you to each one of the panelists for joining us. And I will turn it over to you. And again, many thanks. I look forward to a great discussion.
Well, thank you very much, Nicholas. We appreciate being a part of this every single year. We get tremendous value. I know our clients get tremendous value as we cover at the New York Stock Exchange, both the ETF marketplace and closed-end funds marketplace. It's always fun to run this panel. We tried to go in an interesting direction and make it a little bit unique this year, where we're covering just about every segment of the marketplace. And so I'm joined by truly a team of experts. So I have Luke Oliver. Now, Luke is the head of index investing for the Americas for DWS. John Zimmerman, of course, COO for IndexIQ. Many people know Greg Friedman. Greg is the head of ETF management and strategy for Fidelity. And of course, Jason Ronca, well known as across the industry, is ETF capital markets specialist for BNY Mellon. As I mentioned, backgrounds across each of these gentlemen, both unique, distinct, but also very deep. And so we'll be able to cover quite a few topics. I'm excited. As a reminder, you do have the ability to ask questions live during our session. We are going to try our best to field those questions. So feel free, if you want to hear more about a particular point, or you have a new direction you want to take it. I'm going to do my best as moderator to capture as much audience feedback live, just like we would do if we were in person in New York City. So with that, Greg, I'm going to start with you. The first part of this year, by just about every measure, has been extremely volatile. At the exchange, I can tell you we've seen exceptional levels of volume. ETFs in particular have seen dramatic growth in assets under management, but also a lot of volatility. For those of us that have been in the industry for a while, we've always heard, oh, they just haven't had their test. So I'd love to hear your commentary on, was this the big test? How did ETFs fare? What did you see across all the different, really unique aspects of our marketplace?
Well, thank you, Doug, for the question. And I think the quick answer, we've had several tests. This is not our first test. We've had tests through the Malaysia currency crisis. We've had tests through the Japanese earthquake and tsunami. We've had tests through 07, 08 with the financial crisis. This was just another benchmark for us to see how the funds did in comparison to what our expectations were for our clients. And I think overall, let me start with how the funds performed. They performed as expected. ETFs provide a method of liquidity and access to an asset class when the asset class itself might be illiquid or difficult to access. It offers price discovery. In a lot of cases, allows investors to really gauge where that particular asset class might be pricing at a particular time if the underlying, once again, is not as liquid or trading. So the funds performed well. They performed in line with what we expected. Once again, there's been a history of naysayers about ETFs, and they'll break during times of crisis. This was a 2 standard deviation event. This is the ones that we talk about, where large swaths of the fixed income market just was pricing. You couldn't get access. You couldn't get trades off, but you could within the ETF. And this is just another example how the ETF provides that liquidity and price discovery in an effective mechanism for all of our clients. We did the same thing in 07, 08 with the financial crisis. So, it's tough because people are always still looking for what's that crack and when's the ETF going to show its faults. It doesn't. It performs well. And I think the dislocation we saw in March and April of this year highlights, the benefits of the ETFs, and also, people have the benefits of a mutual fund. I think they perform differently just because of how they operate, but they offer our clients different outcomes based upon, where the risk appetite was and what the liquidity appetite was. So it was very dislocated. We saw a lot of markets within the fixed income space lock up, not have liquidity. We saw phenomenal volumes on the New York Stock Exchange around the equity side of the ETF market, but overall the products worked well. They offered different benefits for our clients, and I think the press and I think our clients appreciated how in the end, when they look back, the performance of these products.
Yeah, I think you made a lot of really interesting points there, Greg. I mean, for those of us who, again, lived through some of the larger standard deviation events, as I like how you put it, particularly with ETFs, this time around felt very different. Even though we had market-wide circuit breakers happening, which was the first time ever, even though we saw exceptional levels of volumes, we didn't see any of the, I'll call them systemic issues that we had seen in the past. And it was reflective of the industry over the last decade coming together and making changes in the infrastructure, right? We didn't see the level of halts. We didn't see the level of stopped trading, if you will, even though some of the underlying assets, as you mentioned, particularly in fixed income themselves, stopped trading. And our team put together a great piece, if you're interested, by Mark Hecker, Device Data Services, on some of the dislocation, if you want to read more about what happened in March. But as we kind of continue, from your standpoint, Luke, at DWS, obviously you cover another set of investors, set of products. What are some of the key takeaways that you and your team felt coming out of March? Are you looking at things differently, so to speak, as a result of what you saw?
Yeah, and I'd also like just to add a little bit to that liquidity question, because it's such an important point that ETFs keep being tested. And so one of our observations this time around is they continue to do exactly what they were supposed to do. And I think fixed income is such a great example because only about 20% of fixed income trades every day, whereas these ETFs are trading every day. So that price discovery point that Greg made is a really strong one, in that even in some cases during this period in March, where we saw some ETFs trading slightly away, maybe 2% away from where the underlying bonds were being marked, didn't necessarily mean that there's a 2% premium or discount. Simply, you have a vehicle that is trading and can be executed at those prices right now. And so what that means is that it's the underlying market which is out of sync or delayed and stale, versus the ETF being the live actionable price. So that's a really key point. This isn't the tail wagging the dog. ETFs aren't driving the underlying market. They're giving the cleanest, truest valuation that you can actually trade on those markets. So I think ETFs really showed their value again during this pandemic, because they were the liquidity vehicle. And we certainly saw, as you said about volumes, people really trading them. And that's what they're there for. As far as other changes that we've certainly seen people, it's been interesting, the kind of pent up demand, some of the stimulus has allowed this V-shaped recovery to really swing back in, but there's still some headwinds there, and we should still be a little bit cautious. So we've seen investors really you've seen huge flows into some of the ultra short duration products, which kind of give you an indication of where investors are, but at the same time, people don't want to miss out on some of the upside. So we've really seen people kind of barbelling where they've been heading with their investments, and the conversations we've had have been at those two ends of the spectrum.
Yeah, it's interesting, you brought up a few good points there, and one of the areas that I was hoping, Jason, given your background, what your team focuses on is, especially in ETF capital markets, ETF trading, what did you see, I guess, if we, instead of looking backwards at March, but then say look forward, for an advisor, investor, folks who are really getting into ETFs, your team specializes, entirely on trading. Do you tend to talk through tips or best practices, or as a result of March, are you saying something different? How are you educating your clientele?
Yeah, thanks, Doug, and great question. And I'll say, really, there are three best practices that I generally give to advisors, especially ones that may be newer to ETFs or not as familiar with trading ETFs. The first, and it's well known, or at least I hope it's well known at this point, is very rarely use a market order. I always tell advisors either use a limit order when placing a trade, or what's known as a not held order. The reason being, a market order has no price target. It can lead to high trading costs during volatile markets. Yes, you'll get immediate execution, but you're going to pay for that immediate liquidity with a really poor price for your clients. With a limit order, you're able to set the maximum price you're willing to pay for shares, or even the minimum price you're willing to sell for. You're not guaranteed execution, but at least your client's interests are protected. And like I said, depending on the client and the level of sophistication, I sometimes recommend not held orders. This gives the broker or trading desk discretion over when and how to trade on your behalf. You're in effect outsourcing execution to trading professionals who have better tools to evaluate execution options. 2, and this is a big one, do not trade during the first or last 20 minutes of market hours. The markets can be really volatile during this time, and you're likely going to see less liquidity and wider spreads during these 2 periods. And last, and this one doesn't get as much airtime, but be aware of what type of ETF you're trading and understand if the underlying market is open or closed at that time. It could be on a holiday, or bond markets tend to liquidity tends to dry up earlier than the equity markets. So generally speaking, prices will be better and the market more liquid when ETF market makers have greater visibility into where the underlying market trades, their ability to offload risk in those markets fairly efficiency. Because then, and this was touched on by Greg and Luke, liquidity in ETF is mostly driven by trading in the underlying portfolio, and it may be reduced when markets are liquid or closed. So those are really the 3 points I give advisors when discussing trading of ETFs, and they're of uber importance during times like we saw in March.
Yeah, and I think your point about watching the underlying markets. I always think about Columbus Day. We always get a lot of emails at the exchange saying, "Hey, reminder, equity markets are open, fixed income markets tend to be closed. Watch fixed income ETFs." So we're going to come back a bit later. I want to talk more about what your team does and the role of ETF capital markets, because that exists at just about every ETF issuer, and it's so important to some of the services that are out there for advisors that are watching this panel. So, but staying on that topic that he brought up of volatility, to some extent, John, IndexIQ is a bit in the business of volatility. You've got some really unique products that can support investors when they start to be concerned. So I always wonder, and I always look to you for a bit of guidance of, given so much uncertainty, given some of the ways we measure that, like the VIX, what are you talking about today to your clients, to advisors? How are you looking at the overall environment?
Thanks, Doug, and thanks everyone for having me today. There's obviously no shortage of uncertainty right now. I mean, in an environment where a global trade war seems almost quaint compared to a global pandemic and a impending election, there's a lot to think about. One thing that we're hearing a lot from our clients, in addition to volatility, is where they can expect returns going forward, given where equity market valuations are, given the returns coming from a small subset of names within the equity markets. And then also on the fixed income side, given where rates are, there are some real fundamental questions around that. We strongly recommend staying invested, but that is with the caveat of smart asset allocation, right? ETFs are perfect for asset allocation, making long-term strategic, but also tactical trades within that. And so that is really core. I think building core ETF portfolios using a long-term asset allocation approach is critical. We strongly recommend and advocate for alternatives being part of that asset allocation. I think especially with some of those valuation concerns that we're seeing now, the benefits of bringing in some portfolio diversification into that allocation is critical. And I think we'll continue to see that over the cycle. Whatever happens with the election, whatever happens with the pandemic, that broader structure around your portfolio is going to be really important for all investors.
And I probably even should have started, every one of the issuers that are on screen with us today, their websites have incredible amounts of information for those that are looking for additional knowledge about the market environment and how to react in your portfolios. I do encourage you to check out their websites, always up to date with interesting information. So along those lines, Greg, I want to come to you and I want to talk a little bit about the world of active management. As we start to think about 2020, early in the year, I happened to be on a news clip, and I happened to say the words of, I think 2020 might be the year of active management. And so it's sort of stuck, and people gave me a hard time, but now I don't feel so bad about the statement. I was looking at cash flows. I think we've about doubled net cash flow in active ETFs this year. My team kicked off an active ETF newsletter. You guys in particular are sort of leading the space here where you've launched these semi-transparent ETF structures. What are your general thoughts? I mean, Fidelity, well known for active. What are you thinking about with respect to the ETF wrapper? How does active fit into the ETF wrapper? What does the landscape look like? Your experience? I mean, take it away. Greg, we have you.
A lot of questions there, so let me see if I can at least catch 5 or 6 of the ones you threw at me pretty quick. Yeah, the active ETF space has been used and has been successfully, populated with great fixed income products. If you take the chapters of ETFs, and I've been fortunate to be involved in ETFs almost since the very beginning, 1996. And the first chapter is really the beta or the index space. Chapter 2 allowed asset managers to create self-indexes and think about, with the help of the fantastic index providers on the street today, smart beta, which is really solutions, strategies, or outcomes for our clients. The third chapter, which we're in and growing, is the active space. So active fixed income have been around for a decade now, providing a lot of great solutions and outcomes for our clients in terms of excess return around fixed income products. But the one slot that's been missing in our clients' toolbox has been the active equity piece of it. And that's because the equity markets are more efficient than fixed income. The equity portfolio managers are a little more concerned about slippage, giving away research, trading strategies. Where on the fixed income side, that concern is not the same, just because of the market structure and how you execute the particular bonds. So, we've seen growth in active fixed income over the last couple of years. Last year was a great asset gathering year for all the industry around active fixed income. But as you said, and you predicted early in the year, this is the year of the active. Now, it's a year of a lot of other things. I didn't hear you talk about the other things that we have to go through this year. But in terms of active, you're spot on. This is the year that we got approval from the SEC to do what they're calling non-transparent active equity. At Fidelity, we don't like the term non-transparent. There's nothing good about non. These are just active equity ETFs. They might have a little different structure to them, but they behave, trade, feel, and supply solutions for our clients the same as any other ETF does. So we're calling them active equity ETFs. So we are fortunate to launch our first 3 on June 4th. There's been 5 different processes that have been approved by the SEC, all from very good, very reputable firms. All the technology are going to work for the client. In the end, the client should be really concerned with, how does my ETF perform to that of the benchmark? Am I getting the excess return? How's my client experience? How's my trading? Am I getting good execution? That should be really what they're focused on 3 to 5 years from now. Right now, everyone is really focused on these technologies and bringing this new application to clients. We think our technology is unique. We're committed at Fidelity to being the home of our active ETF trade, not only just for our technology and our own products, but our partnerships we have with other asset managers, our ability to educate, our ability to have platforms and execution. So we're really focused on this space, but it's early days. The first products were launched, I believe, in April. Ours were launched in June. There's maybe 7, 8 funds out there, but this really is going to change the landscape of ETFs. Let me explain why. Yes, these are new products, and I'm a product guy down deep. These are innovative products. This is something the industry's been working on as a whole since 2008, 2007. And it's a big missing component to someone's building block approach. But I think where it's going to really change, you're going to see now for the first time, traditional mutual fund asset managers getting into the ETF space. You're going to see firms that have never done it because there wasn't a way to protect their IP. There wasn't a way to protect their trading strategies. And now they can produce quality products as they do in a mutual fund into an ETF wrapper. And a lot of these firms, including us at Fidelity, we're wrapper agnostic. It could be a mutual fund, it could be an ETF, it could be an SMA, it could be a model. Our goal is, how do we bring the best of our capabilities to our clients? So firms that have only had mutual fund wrappers to date can now offer ETF wrappers as well and give their clients a choice. Do I want it in a mutual fund form or an ETF form? But how do I satisfy and how do I do the right thing for a client? So that's the big change I see on the horizon. I think the bank shot of this is it can change distribution. How you distribute a mutual fund, how you distribute product to clients is going to change, because once you put it on an exchange like the New York Stock Exchange or SIBO, they're wrapper agnostic. You don't have to have a platform. You don't have to pay for a platform. These trade on an exchange. They trade well. Their markets are made by very successful and wonderful market makers. So it's really going to change the distribution of ETFs going forward. So this has been a big change. You know, New York's been on the forefront of this, as I said before. They're a great partner of ours and others. They've got their own technology, but really it's going to come down to how the funds perform. And this, the first time, allows our clients to build that missing building block of the active equity piece of ETFs.
Yeah, we're, you know, as you mentioned, we're really excited at the New York Stock Exchange. We've built a tremendous platform to support all these new technologies. At the end of the day, our belief is it'll be one more opportunity for a great active manager to distribute their product and do it in a way that tends to be a little bit more tax efficient and a little bit less expensive, and can do so with a US product and go global with it. So tremendous opportunities. Those that want to learn more, you can come to our website, nyse.com, or the home of ETFs.com. We actually have an active ETF newsletter you can subscribe to. So please, if you have questions, let any of us know. We're happy to help you. With that, though, I really want to talk about another major headline, and that's China and investing in China. Luke, you and I have known each other for many years, and this topic never ceases to come up. Now more than ever, though, definitely dominating the headlines. So I'm curious to hear about what DWS is thinking about investments in China. You know, what are you telling your clients right now?
Yeah, it's a big topic. I mean, it's a huge topic, and there's so many facets to it. But I think if there was one takeaway right off the bat, I would say China investments, and specifically the A shares that we always talk about. So mainland China, most investors only have access to China via the Hong Kong listings, some of the New York listings. Even in the big emerging market products, the A shares, the mainland Chinese stocks, have been very absent and are very, very much underweight. And so we've always been talking about the need for people to include A shares in their allocation, whether it's for EM or broadly or world. China's just too big to ignore. So the kind of headline that I like about this is that the Chinese market as a portfolio allocation has done exactly what it's supposed to do. Has very low correlations, and it actually weathered this storm better than the S&P did, and so created diversification, and actually has performed very well. So with that, and that's the story we've told for a long time, that the fact that the correlation to the S&P is something like 0.3, and we've got one of the fastest growing economies in the world, it really is a great allocation. Now, that's not without risk, but that risk has actually equated to diversification and has been additive to risk return profile. So China still, for us, is a fantastic allocation to make, and especially if you're a global investor, you have an international sleeve, you have an emerging market sleeve, you're probably still underweight China. But now, as far as our view on China, we've upgraded our view on China for 2020 from a 1% growth to 2% GDP growth. Which we see as very positive. However, that's significantly lower than the 8 or 9% that China has seen pretty consistently for the last 30 years. That said, we're forecasting 8.5% next year. And China is one of the only, in fact, the only country that we see returning back to pre-COVID levels by end of year. So we're quite constructive on China, and especially the A-share market. So we saw stimulus in China. I think now we're seeing that China seems to be saving its powder. So we feel somewhat confident that should it be needed, there is a lot more gas in the tank. And at the moment, that's not being used. So we think that some of the factors that have been supportive to the US market coming back, that gas is still in the tank in China. So very optimistic on where China fits, the fact that people are systematically underweight China, and the diversification benefits of China. Not to mention this overarching growth story, which I think goes beyond trade wars, goes beyond current headlines. I don't think anyone questions if China will be the largest economy in the world. I think we all know that it's a case of when China will become the largest economy in the world. And there are products available in ETF wrapper that allow you to get access to that market today, and not wait until full inclusion in indices, or any other signal, these products are available and they just haven't been utilized to the level that other countries have been accessed. So I think there's a big opportunity on the table there for investors.
Great, thanks for that. To clean up a question that came in, yes, a lot of firms are working towards the idea of converting current ETFs, or excuse me, current mutual funds into an active ETF wrapper. So if you want to learn more, feel free to reach out to me, my team, or any of the panelists that want to discuss the topic further. I do want to come back though to Jason. We talked about all the new things in 2020, all these big events that have happened. One of them, obviously, BNY Mellon stepping into the ETF market. Why now and why in this environment, and what's it like being a brand new issuer in what is now a $7 trillion global market?
Thanks, Doug. Yeah, the timing in terms of how the markets were acting around the time of our launch certainly made things interesting. But to answer your question, BNY Mellon has always had a large presence in the ETF ecosystem, going back to the early days. Our asset servicing unit, the unit that strikes the NAV, custodies ETF assets, trade settlements, and those types of activities, has been around since the early days. Pershing and the role they play as custodian for advisors who trade ETFs. We have an ETF trading desk that plays a role of authorized participant for numerous US listed ETFs. In our index business, which is a fairly large business, sub-advises a number of ETFs today. So offering our own proprietary ETFs as an issuer was just a natural fit for BNY Mellon as an organization, given the breadth of our existing services in the space. But in terms of the launch itself and the products themselves, I like to always say we have last mover advantage. And what I mean by that is our suite of 8 index ETFs encompass the core building blocks in client portfolios and represents about 60% of all ETF assets by category. So we felt this was a natural place to start, having hindsight being 2020, knowing where assets have been going in terms of the ETF wrapper. Additionally, we are offering the largest US equity and US fixed income categories in the entire ETF marketplace to our clients at a 0 fee. There's no gimmicks, there's no limitations to that number, no restrictions on asset size or holding period or the nature of your relationship with BNY Mellon. 0 means 0. So assets are growing. We're very pleased with the traction we're seeing in the first several months of trading, and I'm really optimistic about the future of the business based on the traction that we've seen in just about 5 months of performance history now.
Yeah, well, thanks a lot for sharing. We obviously, my team, we get a lot of questions of is it too late to join, and our feeling is no. The pie keeps growing, the opportunities keep growing. So if for those interested in building your business, we're happy to help you. John, I want to keep on the major. We're trying to hit. By the way, if you're listening to the panelists, we're hitting like every major topic we can in our short amount of time. So we haven't talked elections. We have to talk elections. Volatility of elections. Again, IndexIQ, you tend to be thought leaders in this space. What are you talking to your advisors about how they position themselves, knowing that there will be continued election coverage and probably continued volatility as a result?
Yeah, thanks, Doug. And there's certainly a lot of things going on. But if the election was the only thing happening this year, which it certainly isn't, our team at New York Life Investments, which IndexIQ is a part of, done a lot of research on this. And if it was only the elections coming this year, we would expect more volatility. So over the 60 days leading into an election over the last 30 years has seen a 40% increase in the VIX. And so we'd expect something similar here, especially given everything else going on in the world. And so volatility is coming. What exactly is going to happen is, something we're not necessarily in the business of. Our team has gone through and looked at all the possible scenarios. I think the biggest headline risk that most investors here are probably aware of and some thinking about would be a Democratic sweep and the tax headline risk that may come with that. I think that's real, but what we try to focus on for all investors is really what's the long-term policy impacts of any change or not change as a result of the elections. That's going to take time to really show what the real results are. Obviously, the market will be discounting the expectations for what those policy changes are, what is going to be enacted as a result of those election results. But that time really goes back to that staying invested in the asset allocation, right? And that's really important to stay invested throughout this election cycle, because we're going to see the volatility. But things you can do within asset allocation while keeping some upside is really important. We talked about alternatives earlier, but within the core equity and fixed income buckets, there's ways to increase and maintain some low volatility exposures, right? So high yield is one of them. You can choose ETFs that eliminate the lowest credit quality names within a high yield bucket. Similarly, in other parts of the space. So there's a lot of options that ETFs provide that allow you to stay invested, participate in the uncertainty that's gonna come, but make your portfolio more aware of potential downside to come.
Thanks for that. And by the way, if it's not crystal clear, no one's trying to do a product pitch, but the ideas and the way of investing that each of the panelists are talking about, they have ETFs that cover this space. So, the idea of being able to stay invested with protection, you can go to the IndexIQ website. The idea of investing in China, right? You can go to the DWS website. So Fidelity's website, BNY Mellon's website, all of these are available in an ETF. And I love the phrase of there's an ETF for that. And we tend to hear that a lot. Now, Greg, you and I have known each other a long time. I won't count numbers of years, but we've both been in this market for a while. Certainly by now you have a list, I'll say, of, here are the things that you don't want to do as a mistake. I'll call them trading errors or misconceptions on trading, or, what are some of the top tips, if you will, in the Greg Friedman bucket of, best practices for ETFs?
No, absolutely. And yeah, I just want to before I answer that question, I want to get back to Jason's question about the conversion. Yes, there's nothing prohibiting conversions. It's just a lot of work. I think, the best thing to do is consult with outside counsel, consult with your board, because yes, it's possible. And I think a lot of people are talking about it. It's an exciting development around the industry, but I think there's some careful considerations and processes that, should be taken into consideration. So to the Greg Friedman bucket of what not to do, I probably have done it all myself. So it's really an endless bucket. But I think it plays right into what Jason was talking about, a few moments ago. Is you don't want to really put a market on open trade or market on closed trade. That's when the opening auctions and closing auctions. That's when there's some volatility. That's when you're not going to get the best execution. We're big with limit orders. We're big with being careful and smart. And the wonderful thing about the industry, even though it's grown as much as it has since you and I started working together, Doug, it's still a very focused industry on doing what's right for clients. So every sponsor on the website has trading secrets, trading tips. And I think everyone, universally is, you don't want to do a market open or market close order, do a limit order, and just be smart how you do it, because these are volatile products. We are in volatile times. We do have open auction and closing auctions for as well run as New York has got. For example, their trading processes, there's still some chance. So just be smart in how you trade. Firms like ours, others, Jason's comments today, I think are extremely valuable and spot on for the investor at the end.
Yeah, and you mentioned, the idea of the ETF capital markets being there to support. I want to come back to that in a minute, because watching time, I want to make sure we hit every major topic. Luke, let's pick another one. So let's talk ESG. Mm-hmm. Again, headline dominating to some effect. We've seen ESG in equity. Now we're starting to see ESG in fixed income. I know my own parent company offers a series of fixed income ESG indexes and the ability to build your own. Is this the new greenfield opportunity? Is this, the place where, ETFs are going to continue to grow, or investors are going to grow their exposure? What are you seeing from DWS angle?
Yeah, well, I mean, you're exactly right. There's been huge growth. This year, we've had 19 billion flow into ESG ETFs, bringing us to 40 billion in total. So with market growth, there's well over 100% growth in inflows over where we started the year. So we've seen a huge adoption of ESG. We ourselves have expanded our range. We now offer large cap US, we offer EFA, emerging markets, or world, and we just recently launched our fixed income, investment grade, high yield, and emerging market debt. So we cover about 70% of a portfolio through those exposures, and we've got some more to come to continue filling out that portfolio. So we're taking a real stance in ESG. Is it a greenfield opportunity? We see it as an opportunity to participate in the core of portfolios. We're not offering in these particular products a thematic approach. This isn't saying, hey, this is a bet if you think green energy is going to be a dominant field in the future. We're saying, here is the S&P 500, here is the MSCI EFA. We're giving those benchmarks, low tracking to those original regular benchmarks, but with an ESG screening inside the fund. So there's two things here. One, we're seeing that it is an opportunity for us as an issuer, and it's an opportunity for the industry to offer these products, because there is a growing demand for it, not just from in the US, but with some of the major investors this year have been European institutions that have been very aggressively moving into ESG. So we think there is still a big wave of US investors to adopt it. But here's the absolute critical point that gets lost in the ESG conversation every time it comes up. And that is that ESG, environment, social, governance, sounds like and is initially pitched as this is a values-based way of investing. This is very much a capitalist way of approaching a portfolio. This is not in conflict with being a fiduciary, because when you look at what these really mean, I mean, governance is very clear. You're looking at companies that are less prone to corruption, that have better control frameworks. When you look at social, there's things in the social screens like product safety, employee safety, records of accidents. So things that, if companies are good at those things and have good records, arguably they're stronger, better quality companies, less prone to huge recalls of product, for example. And then when you look at environmental, not only are these companies that are serving the environment better and social, serving their communities better, these are companies that are using resources more efficiently, or actually being additive to preparing themselves for a world perhaps without fossil fuels. And so firms that are better prepared. So what I'm trying to say is that strong ESG companies are arguably better companies. Why are we not all using ESG all the time? And that's the interesting thing. In the past, analysts only looked at financial metrics, or for the most part looked at financial metrics to measure a company's potential performance. ESG are just non-financial metrics that we can now use to measure companies, because the data is more abundant, the data is more transparent, and we have better ways of measuring it. So these, I believe, in the future, an active manager or a passive manager, ESG are just going to be filters. People will not accept that the active analyst or the index hasn't considered that these companies have flaws. So ESG are going to be mainstream. So I think there's an opportunity now that this is a new green field that we can add product and serve clients by bringing to market these ESG. But I'd like to think in the future, this is just investing. And it's a little bit to Greg's point earlier about non-transparent active. It's a great innovation, but really this is just another vehicle that does something slightly different. We shouldn't get too bogged down on the differences. So long story short, ESG is definitely a real movement. It's not a fad. And this is a real fiduciary-based investment methodology. And so I don't want people to get sidetracked by the value versus being a fiduciary. ESG does both. And if you look at the performance through this volatility, that really plays out.
Thanks, Luke. John, I see you kind of nodding your head quite a bit, and I know you're involved in this space, extensively. Would you mind just adding a few more comments?
No, I just really agree with Luke. I mean, I think the reemphasizing his point that ESG is a whole because there's a core opportunity for ESG, right? Where it is an arguably better way to look and evaluate a company as opposed to just looking at financials and growth ratios, right? You got to look at it as a whole, and that is, I just want to further distinguish that from investing in low carbon emission companies or something along those lines. Those are valid thematic investments. There's nothing wrong with those, but it's separate from the ESG that Luke is talking about, and has really been the real driver of growth in the ETF market this year.
Thank you. So Jason, we have 2 minutes left on our panel here. If you could, would you mind closing us out on ETF trading, what it is ETF capital markets teams offer at issuers? How does that team and that role support the advisors that are out there watching?
Yeah, I'll keep this brief, sensitive to the time, but I always encourage advisors to reach out, no matter how large or small the question is about the trading or liquidity profile of any ETF. This is what the capital markets desk is designed for. And it's somewhat a role bespoke to ETFs. And we cap markets people like to think of ourselves as a jack of all trades. And advisors sometimes wait until the point of trade to reach out and call, which is of course fine. We can provide input at that point on where to source liquidity, size and depth of order book, or even limit order guidance. But also use us early on in the due diligence when you're evaluating the ETF. Happy to provide historical info around spreads, daily volumes, and really we can provide examples of past executions to show the efficiency of the trade in a particular ticker. So we like to receive phone calls, we like to receive emails, don't be shy. Leverage us as a resource to help make the best decisions for your clients.
Yeah, it's great. And as we close out, I personally worked on an ETF capital markets desk for many years. It's a great position. All you do is help advisors, help institutions get better prices all day. So it's a really neat role. Well, I want to thank each of you gentlemen for taking the time here today and joining us. I want to thank the Capital Links team doing a great job. Many of us have digital booths. I invite you to go and pop in and say hello, learn more. And for those who want to learn more about ETFs in general, come to the home of ETFs.com. That'll redirect you to the New York Stock Exchange webpage, and me and my team, we can help you from there. So with that, we'll wrap up. Thank you all, and enjoy the rest of the conference.
Thank you.
Thank you.
Thank you, everyone.
Thank you.